For years, de-dollarization sounded like a political slogan, but today it's showing up in data. The US dollar has dominated the global financial system for decades. It accounts for roughly 60% of global foreign exchange reserves. Most commodities are still priced in dollars. The US Treasury market remains the deepest and most liquid in the world. So at first glance, nothing looks broken. But reserve currency transitions don't begin with collapse, they begin with marginal shifts. Over the last decade, central banks have gradually reduced the percentage of reserves held in dollars, not dramatically, not suddenly, gradually. At the same time, gold purchases by central banks have increased. Regional currencies are being used more frequently in bilateral trade. Payment systems outside the traditional dollar network are expanding. Each move looks small, but collectively they signal diversification. And diversification matters, because reserve currency dominance is not just about trust, it's about necessity. When global trade requires dollars, demand is automatic. When energy settlements require dollars, demand is structural. But when alternatives begin to exist, even partially, that automatic demand weakens. Now here's the key point. De-dollarization does not mean the dollar disappears, it means its share declines. A shift from 60% to 50% over a decade may not sound dramatic, but in a $100 trillion global system, that shift changes capital flows. And capital flows determine yields. If foreign reserve managers gradually reduce dollar exposure, Treasury demand dynamics change. That affects interest rates, that affects mortgage costs, that affects corporate borrowing. This is not ideological, it's mechanical. Currency systems change when incentives change. Today, geopolitical tensions, sanctions policy, and regional alliances are influencing those incentives. Still, there's no immediate replacement for the dollar. The euro faces structural fragmentation. The yuan faces capital controls. Gold cannot replace transaction liquidity. So what we are witnessing is not replacement, it's redistribution. And redistribution over time reshapes the system. The dollar is not collapsing, but it is being tested. And the real question is not whether de-dollarization exists. The real question is how far diversification can go before markets reprice risk. That's where this story becomes important.
If you want to understand de-dollarization, watch energy markets. Because the global dollar system was reinforced by oil. For decades, global energy trade has been settled primarily in US dollars. Oil importing nations needed dollars. Oil exporting nations accumulated dollars and recycled them into US assets, especially treasuries. That recycling cycle supported the system. It created structural dollar demand. But today, parts of that system are evolving. China has settled some energy trades in yuan. BRICS nations are expanding non-dollar agreements. Regional commodity settlement frameworks are developing. These are not majority flows, but they are measurable flows. Even a 10% shift in global energy settlement away from dollars reduces automatic demand, and reserve currency strength depends on automatic demand. The dollar remains dominant in oil pricing for now, but pricing dominance and settlement dominance are not identical. If settlement currencies diversify, recycling patterns adjust. That means fewer petrodollars flowing back into treasuries. Over time, that influences funding conditions. Now, here's the nuance. Energy markets move slowly. Infrastructure, contracts, and financial plumbing do not change overnight. But shifts in direction matter more than speed. If global trade becomes more multi-currency, the dollar becomes one major player among several, instead of the central anchor. That doesn't equal collapse. It equals reduced leverage. Reserve currencies derive power from being indispensable, The more alternatives exist, the less indispensable any single currency becomes. And in a fragmented world, currency influence distributes across blocks. The US dollar still dominates global liquidity, but dominance with competition feels different than dominance without challenge. Energy trade is not just about oil prices, it's about the underlying architecture of demand for your currency. And that architecture is gradually evolving. The shift is not loud, it's structural. And structural shifts are the ones that last.
At the center of de-dollarization lies one market, U.S. Treasuries. For decades, foreign buyers absorbed significant portions of U.S. debt issuance. Central banks, sovereign wealth funds, and exporters recycled surplus dollars into American bonds. That steady demand helped suppress yields. But recently, foreign participation has flattened and in certain periods declined. This does not mean panic selling. It means diversification. When foreign reserve managers allocate slightly less to treasuries, someone else must step in. Either domestic institutions absorb the supply, or yields rise to attract buyers, or central bank policy intervenes. Higher yields change everything. They affect mortgage rates, corporate financing costs, equity valuations, government interest expenses. This is where de-dollarization moves from theory to tangible impact. It's not about symbolism, it's about who finances U.S. deficits. The U.S. runs persistent fiscal deficits. That requires steady demand for debt issuance. If global demand shifts, even gradually, funding costs adjust. However, here's the counterforce. In times of crisis, capital still flows into the dollar. The dollar remains the world's primary safe haven currency. That creates a paradox. Structurally, diversification is increasing. Cyclically, dollar strength persists. This tension produces volatility, not collapse, volatility. And volatility creates repricing moments. The future of the dollar may not be binary, dominant, or irrelevant. It may be transitional, from singular dominance to shared influence. If that transition unfolds slowly, markets adapt. If it accelerates, markets react. The real takeaway is simple. De-dollarization is not a headline event. It is a gradual adjustment in capital allocation. And capital allocation ultimately shapes the global financial system. The question is not whether change is happening. The question is whether markets are prepared for its long-term effects. What if de-dollarization doesn't collapse the system overnight, but instead slowly rewires global finance piece by piece? No dramatic crash, no headlines screaming "dollar dead." Just a gradual shift in settlement currencies, reserve allocations, and geopolitical alignment. And that kind of change can be far more powerful. Today, we're not asking whether the dollar disappears, we're asking something more serious. What happens if de-dollarization becomes measurable and persistent? Let's imagine a realistic scenario. Not 50% of trade suddenly moving away from the dollar, but 5 to 10% over the next decade. Energy contracts priced partially in yuan. Bilateral trade settled in local currencies. Central banks increasing gold allocations modestly. Digital payment systems bypassing traditional dollar clearing routes. Individually, these are small changes. Collectively, they create structural pressure. The dollar doesn't need to collapse to lose influence. It only needs to lose marginal dominance. And here's the key. Reserve currency status is not binary, it's a spectrum. Now here's where things become more serious. For decades, surplus dollars from oil exporters and trade partners were recycled into U.S. treasuries. That created steady structural demand. But if fewer transactions are settled in dollars, fewer surplus dollars need to be parked in treasuries. Even a modest decline in structural demand could mean higher borrowing costs, greater yield volatility, and increased reliance on domestic buyers. We're not talking about a funding crisis, we're talking about pricing power. And pricing power affects fiscal flexibility. De-dollarization is rarely just about economics, it's about strategic autonomy. Sanctions over the past decade have sent a clear message. Access to dollar-based systems can be restricted, so some countries are building alternatives, not to destroy the system, but to reduce vulnerability. Parallel payment rails, currency swap lines, regional clearing mechanisms. This doesn't mean the dollar disappears, it means the global financial system becomes more multipolar. And multipolar systems tend to be less stable, but more competitive. Instead of watching headlines, watch the data. The share of the dollar in global reserves, the currency composition of energy trade, the growth of cross-border settlement systems, gold purchases by central banks, the distribution of Treasury ownership. These are slow-moving indicators, but slow indicators move markets before narratives catch up. Structural trends don't explode, they compound. Now here's the balancing perspective. The dollar still dominates for three fundamental reasons: deep capital markets, legal and institutional stability, liquidity unmatched by any alternative. No other currency currently offers the full package. The euro faces fragmentation risks. The yuan faces capital controls. Gold cannot digitally settle global trade. So de-dollarization is not necessarily about replacement, it is about dilution. And dilution takes time. Here's the real conclusion. De-dollarization is neither a myth nor an imminent collapse. It is a measurable shift, but a gradual one. The dollar may remain dominant, but dominance can shrink without disappearing. And in global finance, marginal changes at the top can create significant consequences underneath. The real question is not, is the dollar ending? The real question is the world quietly preparing for a less dollar-centric future? Because if it is, the shift won't be loud, it will be structural. And by the time it feels obvious, it will already be priced in.